Columbia Banking System printed Q1 2026 earnings this morning, and here is the head-scratcher that kicks us off today. They missed EPS by 2 cents, yet the stock rallied 2.24% into the close.
That is the kind of tape action that stops you mid-scroll. EPS came in at 66 cents against a 68-cent consensus, but revenue absolutely blew the doors off the street estimate.
Revenue printed at $816 million against a Wall Street estimate of $677 million. That is a $139 million beat, or 20.5% above expectations.
So the narrative writes itself right now. Miss on the bottom line, beat on the top line, and the market decided revenue quality matters more than a 2-cent EPS shortfall on a Pacific Northwest regional bank.
The stock closed at $29.65, putting Columbia Banking about 9.4% below its 52-week high of $32.70. Forward PE sits at 9.7 times.
And the dividend yield, that number is hard to ignore at 4.92% on a bank trading near tangible book. We have a lot to unpack on whether this is value or a credit warning sign.
I am Alex, he is Sam, and this is Charged Alpha, the show that breaks down every earnings print that actually matters to investors.
Columbia Banking System trades under ticker COLB and operates as a regional banking franchise headquartered in Tacoma, Washington. The company was founded in 1993 and has grown into the Pacific Northwest's largest bank by total assets.
The footprint spans 153 branches across Washington, Oregon, Idaho, and California. This is the deposit franchise story in the Pacific Northwest, and it all changed materially after the Umpqua Holdings merger of equals closed in March of 2023.
That $5.3 billion merger created a $66 billion total asset institution overnight. Post-merger, Columbia Banking now commands the top regional share across the Seattle, Portland, and Boise metro deposit markets.
The revenue mix is classic regional bank. Net interest income contributes roughly 67% of the top line, while non-interest income covers the remaining 33% through fees, service charges, and treasury management.
Total loans sit at approximately $41 billion, deposits at $54.5 billion. That gives Columbia a loan-to-deposit ratio around 75%, which leaves room for additional commercial loan growth without tapping wholesale funding.
The balance sheet carries $577 million in cash and zero traditional corporate debt. Columbia is funded entirely by its $54.5 billion deposit base, which is the dream setup for any bank in a tight-rate environment.
Employees total 4,721 across the footprint. Goodwill and intangibles from the Umpqua deal sit at $1.482 billion and $671 million respectively, which we will revisit in bear case territory.
One feature that stands out for risk-minded investors is the beta. Columbia Banking trades at a beta of 0.683, which makes it less volatile than the broader market and a classic defensive regional bank exposure.
Market capitalization comes in at $7.07 billion across roughly 238 million shares outstanding. Price to book sits at 1.13 times, barely above tangible book value per share of $23.12.
The CEO running the show at Columbia Banking is Clinton E. Stein, who took the top job in June of 2022 as the merger of equals was being finalized. He also holds the president title.
Stein joined Columbia through the Umpqua Holdings combination, where he previously served as president of Umpqua Bank. He brought decades of commercial banking experience from the Oregon side of the Pacific Northwest franchise.
Before Umpqua, Stein spent years at Bank of America and other major financial institutions building out commercial credit, treasury management, and corporate banking product sets. His resume reads like a blueprint for running a mid-size regional.
His signature accomplishment is orchestrating the $5.3 billion merger of equals that created today's Columbia Banking System. That deal closed in 2023 and remains one of the larger regional bank combinations of the cycle.
His current mandate is a three-part focus. First is commercial banking growth across the Pacific Northwest. Second is technology modernization to lower the cost structure. And third is finishing off the final stages of merger integration execution.
Let's get into the actual Q1 2026 numbers because this is where the EPS miss story meets the revenue beat story. GAAP EPS came in at 66 cents versus a 68-cent consensus estimate.
That works out to a miss of 2 cents, or roughly 2.9% below the street number. After 3 straight quarters of double-digit beats, Q1 breaks the streak and puts the narrative on notice.
Now, flip to the plot line. Revenue printed at $816 million against a Wall Street consensus of $677 million. That is a $139 million beat, or 20.5% above estimates.
A 20% revenue beat, combined with a 3% EPS miss, tells you exactly where the pressure showed up. Something between revenue and net income consumed the upside, almost certainly a provision for credit losses.
Net interest margin came in at 3.55% on a trailing 12-month basis. Efficiency ratio clocked 58.2%, which is a dramatic improvement from the 68% peak during integration in FY 2023.
Return on assets sits at 0.82% and return on equity at 7.02%. Those are below the best-in-class regional benchmarks, but they are normalizing off the merger integration drag.
Revenue TTM reached $3.26 billion, and full-year 2026 consensus sits at $3.28 billion. Net margin is a healthy 16.6% for a commercial banking franchise of this scale.
Operating cash flow, trailing 12 months, ran at $600 million, with free cash flow at $550 million. That is high-quality, rate-driven cash generation, backing a dividend that now yields nearly 5%.
The valuation numbers are where this gets interesting. Price to earnings TTM is 13.16 times, but the forward multiple compresses to just 9.7 times against the FY 2026 estimate of $3.06.
Dividend yield sits at 4.92%, with a payout ratio of 51.1%. That is a sustainable payout level for a commercial bank with this asset sensitivity and this level of earnings predictability.
Looking forward, the Street models Q2 2026 EPS at 74 cents against $689 million in revenue. FY 2026 consensus is $3.06 EPS on $3.28 billion in revenue.
Out-year estimates build from there. FY 2027 is pegged at $3.41 EPS on $3.44 billion revenue, and FY 2028 steps to $3.63 on $3.6 billion revenue.
That is roughly a 17% cumulative EPS growth arc over the next 3 fiscal years. If the bank executes, a 9.7 times multiple on FY 2026 looks genuinely compressed versus the regional bank peer set.
Wall Street is sitting on the fence here, and the consensus rating on Columbia Banking is a clear hold. Out of 12 covering analysts, 5 are buy-rated, 7 are hold, and 0 are sell.
The mean price target across the covering analysts is $32.50, which implies upside of 9.6% from the closing price of $29.65. Not a fat target, but not dismissive either.
On the bullish end of the spectrum, Raymond James is the loudest with a strong buy rating and a $36 price target. That is 18% upside if they are right on the Pacific Northwest franchise thesis.
Piper Sandler is also constructive with an overweight rating and a $34 price target. Their work generally leans into the NIM expansion story and the post-merger operating leverage that remains to be captured.
KBW, Keefe, Bruyette & Woods carries an outperform rating with a $33 price target. KBW is the regional bank specialist shop, so their constructive view carries particular weight in the institutional community.
On the more cautious side, Barclays sits at equal weight with a $30 price target. Wells Fargo mirrors that tone at equal weight with a $31 target, essentially pricing in very little upside.
The read-through is that the bulls see the 9.7 forward multiple plus the 4.9% yield, while the neutrals flag credit quality risk in Pacific Northwest commercial real estate as the reason to wait.
Let's walk through the bull case for Columbia Banking in 5 concrete catalysts. First up is the merger integration story, which is essentially the cleanest upside driver on the entire income statement right now.
The efficiency ratio peaked at 68% in FY 2023 during integration, and it is now running at 58.2%. Management is guiding towards sustained 58% levels, and every point improvement drops directly to pre-tax income.
Second catalyst is the franchise value itself. Columbia trades at just 9.7 times forward earnings and 1.13 times book value, yet it owns the number one deposit share in the Pacific Northwest.
Compare that to Pinnacle Financial Partners at 12 times forward, or home bank shares at roughly 3 times sales, and the Columbia franchise looks structurally underpriced relative to its quality and market position.
Third catalyst is asset sensitivity, which is a tailwind in a higher for longer rate regime. NIM sits at 3.55% today, and fixed-rate loans continue to reprice upward as they roll off.
Each quarter, the Federal Reserve holds rates steady. Columbia Banking adds incremental net interest income because the loan book reprices up while deposit costs have largely stabilized. That is pure operating leverage with no effort required.
Fourth catalyst is dividend sustainability and growth potential. The current 4.92% yield is backed by a 51% payout ratio, maintained through the entire multi-year merger integration without a cut.
As earnings continue to normalize upward toward the $3.06 FY 2026 consensus and $3.41 FY 2027 path, there is clear capacity to grow the annual dividend from today's 146 level.
Fifth and final bull case catalyst is what Q1 actually told us about loan demand. Revenue beat consensus by $139 million, or over 20%, which is a massive signal on commercial origination momentum.
If Pacific Northwest commercial loan demand is running that hot against what analysts modeled, then full-year consensus of $3.28 billion in revenue could prove conservative, which would cascade into forward EPS upgrades.
Now let's give the bear case equal airtime with 5 honest risks. Risk number 1 is credit quality deterioration, specifically in Pacific Northwest commercial real estate, where office and multifamily valuations remain under genuine pressure.
That is almost certainly what drove the Q1 EPS miss, despite the revenue beat. Provision expense ran above the normalized run rate, which consumed the revenue upside and dropped the bottom line 2 cents short of the street.
Second risk is NIM compression if the Federal Reserve accelerates rate cuts beyond the current market path. At $66 billion in total assets, each 10 basis point NIM compression equates to roughly $66 million in lost annual net interest income.
Faster than expected cuts would hurt Columbia Banking disproportionately because it is an asset-sensitive balance sheet. The same quality that drives the bull case in a rate hold regime cuts the other direction if the Fed moves aggressively.
Third risk is deposit funding cost pressure from the money market fund complex and online bank competitors. Deposit betas remain elevated, and that dynamic caps NIM upside even in a scenario where the Fed simply holds rates flat.
The competitive pressure on deposit pricing is essentially a permanent feature of the post-2023 banking environment. Customers now have real-time visibility into high-yield alternatives, and that structurally compresses net interest margin for every regional bank.
Fourth risk is goodwill and intangibles impairment exposure. Columbia carries $1.482 billion in goodwill plus $671 million in intangible assets, all of it sourced from the 2023 Umpqua merger.
If the Pacific Northwest economy softens materially, or the modeled merger synergies fail to fully materialize, Columbia could face a goodwill impairment charge that would crush tangible book value and potentially pressure dividend capacity.
Fifth and final bear case risk is the ongoing EPS sensitivity to provision for credit losses. The Q1 miss, despite a 20% revenue beat, is a flashing signal that provision building is starting to eat into reported earnings.
If commercial loan stress persists or even accelerates through the remainder of 2026, provision expense could repeatedly surprise the bottom line, meaning the stock could miss EPS consensus multiple times this year, regardless of revenue momentum.
Let's run Columbia Banking through a peer lens, because regional bank valuation only makes sense relative to the cohort. The peer set here includes Pinnacle Financial, FNB Corp., Home Bank Shares, Prosperity Bank Shares, and Synovus Financial.
Colombia trades at 2.13 times trailing sales with roughly 5% revenue growth. That puts it squarely in the middle of the regional bank pack on valuation, but slightly below average on organic revenue growth.
Pinnacle Financial Partners is the most similar high-quality comp, trading at 2.0 times sales with 8% revenue growth. Pinnacle commands a premium forward PE, which is where the Colombia re-rating thesis lives.
FNB Corp screens as the cheapest on sales at 1.50 times, but with only 4% revenue growth and a more challenged deposit footprint. Colombia looks clearly better positioned on both metrics.
Home Bank Shares is a premium valuation outlier at 3.0 times sales with 6% revenue growth. That stock has historically traded rich because of its profitability and capital return consistency, which is a goal state for Colombia.
Prosperity Bankshares sits at 3.20 times sales with just 2% revenue growth, which looks expensive on the surface. But Prosperity is a consistent dividend grower, which is exactly the template Colombia is aiming for.
Synovus Financial is roughly in line with Colombia at 1.80 times sales and 7% revenue growth. Of the entire peer set, Colombia trades at the cheapest forward price to earnings multiple, which is the real mispricing.
The summary read is that Colombia Banking carries mid-range price-to-sales optics, but a genuinely compressed forward earnings multiple. If merger synergies fully normalize, the stock could re-rate toward the Pinnacle and Home Bank Shares premium band.
Turning to the options market and insider activity on Colombia Banking. Implied volatility on COLB is modest given the low beta profile, and the post-print options activity has been skewed toward upside call buying rather than protective puts.
The relatively low beta of 0.683 translates directly into a lower implied volatility surface than you would see on a more cyclical or deposit-challenged regional bank. That keeps option premiums reasonable for long-term holders.
On the insider front, Colombia Banking has not seen any notable executive selling clusters in recent weeks, which is generally supportive. Insiders retaining exposure through an EPS misprint is a quiet but meaningful confidence signal.
Institutional ownership remains concentrated with the large passive index complexes and regional bank-focused mutual fund holders. That shareholder base tends to be sticky through noisy quarters like this one, which dampens sell pressure.
The bottom line on positioning is that neither the options tape nor the insider activity is flashing any pre-earnings warning signs. If anything, the setup argues for continued grinding re-rating rather than a blow-up scenario.
Here is the bottom line on Colombia Banking after this Q1 2026 print. The EPS miss is real at 2 cents, but the market is clearly looking through it at revenue quality and forward net interest margin trajectory.
The setup that matters is 9.7 times forward earnings, 4.9% dividend yield, 1.13 times book value, and the Pacific Northwest deposit franchise fully underneath it all.
That valuation combination offers genuine downside cushion if credit stays contained through the rest of 2026. The bull re-rating catalyst is efficiency ratio staying at 58% or better, while revenue growth holds the line.
The genuine risk is that provision expense keeps eating EPS, goodwill impairment looms if synergies miss, and Pacific Northwest commercial real estate cracks in a material way over the next several quarters of data.
Our take is that Colombia Banking is a classic value plus yield setup for the patient investor, but absolutely not a screaming high conviction buy. You want to see a clean Q2 before leaning on the position size.
For the deeper model, the peer dashboard, and our full thesis tracker on Colombia Banking, head over to chargedalpha.com, where we keep every metric updated through each fiscal quarter.
Here's the key metric to watch into the Q2 2026 print, which drops roughly 90 days from now. We are laser focused on two variables in combination: net interest margin and provision for credit losses.
If NEM expands from today's 3.55% toward 3.60% or higher, that is the green light on asset sensitivity playing out exactly the way the bull case models it forward.
At the same time, if provision for credit losses stays below $90 million for the quarter, the Q1 miss reads as 1 quarter of noise rather than the beginning of a sustained credit cycle.
If both boxes get checked on the Q2 print, A 9.7 times forward PE, paired with a 4.9% dividend yield, is genuinely compelling risk-reward for a quality Pacific Northwest franchise.
If either metric disappoints, the bear case starts to dominate the narrative. The stock likely retraces toward the $26 area, and the analyst price target distribution compresses toward the Barclays and Wells Fargo end.
That wraps our Charged Alpha deep dive on Columbia Banking System and their Q1 2026 earnings print. Pacific Northwest Regional Bank, EPS miss, revenue beat, 2.24% rally, 9.7 forward, 4.9% yield.
If you found this breakdown useful, please subscribe, share it with an investor friend, and drop a rating on whichever podcast platform you use. It genuinely helps us bring you more earnings-focused content every single week.
We will be back on the next earnings print with another S&P-focused deep dive. Until then, stay curious about the numbers, skeptical of the narrative, and patient with your position sizing.
Thanks for listening to Charged Alpha Podcasts. I'm Alex, he's Sam, and we'll catch you on the next one with fresh analysis and sharper takes on every print that matters.
Quick disclosure before we sign off. Everything discussed on Charged Alpha Podcasts is for educational and informational purposes only, and nothing in this episode constitutes a personalized investment recommendation for any individual listener.
This is not financial advice, and nothing we discuss today should be taken as a recommendation to buy, sell, hold, or trade any security. The hosts may hold long or short positions in any company covered on the show.
Always do your own research, consult a licensed financial advisor who knows your personal situation, and make investment decisions based on your own risk tolerance, time horizon, and financial goals. Thanks for listening to Charged Alpha.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.